So now we're going to talk about the accounting cycle, which is basically the cycle of how we go from putting in all the entries to creating financial statements, right? So it's the sequence of activities that occurs in the accounting process from the occurrence of a transaction through generating financial statements. It's each of the steps, right? So here are the steps in the accounting cycle. So the first is recognition of the event as a transaction and identify and file the source documents, whether it's a receipt, you receive a bill, you wrote a check, there's an invoice, all those kind of things. That's how you recognize. And when we're trying to do the matching principle, right, we're trying to recognize sales with an expense, even if the sales we may get the revenue later on. If we generate an expense, we want to match those up, right? And that's recognition. That's where we get involved with the accrual accounting, because there's going to be some accrual type accounts that get developed so that we can recognize expenses with revenues and make that recognition match up, which is really key. So first is recognition, then analysis. Analyze the transaction, determine which accounts are affected and in which direction. Is it a debit or a credit? Now, debits and credits, we'll talk about them more later. But what they are is in double entry bookkeeping, right, which is what this is. That's the big revelation, in the 1400s, that, each transaction there's two sides, right? When you go to the delicatessen and you buy a sandwich, the operator, gives you the sandwich, and then you give them the money to pay for that sandwich, right? Whatever it is, you go and buy a cookie, they give you the cookie, and you give them the money to pay for that, right? And so those two sides of the transaction are what has to happen. You have to, once you do it, the money either it comes out of your bank account, or you have to somehow reduce the amount of money you had because now you've done this transaction. And on the other side, you've gained whatever it is, the item, whether you bought a bicycle or a car or a sandwich, all those kind of things. You have to show that you got something for that money, and that's the two sides of the transaction. That's what debits and credits mean. Each side has a transaction, and maybe on one side you may pay for something with a little bit of cash and then some credit too, right? And so you'd have two entries on the one side of the account, say the credit side, to pay for the asset on the debit side. So those are the ideas about what we're saying there. Analyze, say what are the different accounts that are impacted by this before you make the entry, right? Then you go and make the journal entry. And that's where the transaction's recorded in the journal as a debit and a credit, or a transaction may have more than one, but the debits must equal the credits so that they balance. This is all about, it's like a mini balance sheet, right? Every transaction has to balance. How much you paid for something is worth the thing that you get. Or what you sell has to be equal to the amount of money you receive in sales for that. It can't be a little bit different. They have to balance. That's the key. That's why the accounting system is so accurate. So then you post those transactions, those entries to the ledger. Journal entries are transferred to the appropriate, what we call T accounts in the general ledger. The T accounts are where, they call them a T account because that line in the middle of the T, the vertical line, splits the debits from the credits. And every transaction it's like a little mini balance sheet. They balance the debits and credits. So then after you've done all that, at the time when you're going to create financial statements, say if it's once a month or whatever, you do a trial balance, right? And that's an unadjusted balance that's generated, and your computer software will actually do this for you now. And it's calculated to verify that the sum of all the debits is equal to the sum of all the credits, right? So if every transaction that you post in every journal entry is accurate and balances, then the trial balance will balance, right? But a lot of times, guess what? They don't. And so then you have to go back and figure out where there's a mistake. And this could be an iterative type of process where you go through and find any errors. And that could be, that could be a hard time, and you may want to have somebody else look at it as well, because as you might, when you've done the transactions and entered them, sometimes it's hard to find the errors. But that sort of troubleshooting part is absolutely key, and that's why you do a trial balance. Then after the trial balance balances and all the debits and credits are balancing up, then it's time to do the adjusting entries. And the adjusting entries are the accrued and deferred items, like accounts receivable, accounts payable, where you have a transaction and you've put that into your expenses, but you haven't actually paid it yet, so it hasn't hit the bank account yet. Or with accounts receivable, you've made a sale, but that was done on some sort of credit terms, and they got the item, but they're going to pay you in 30 days or something. So you have a receivable there, so that cash has not come in yet, so it hasn't hit the bank statement. It hasn't hit the bank account. So then you have an adjusted trial balance, which has those adjusting entries plus the trial balance, and then you look at that balance and calculate that. Again, the software will do it, make sure that works, and from there, the financial statements can be prepared. And again, they'll just pop out of your computer accounting software. But to know how this is going on and what the steps are is really critical, so you understand what the heck's going on. And even though it's easy now, it's not that easy. And when there's a mistake, you have to know where in the sequence that mistake might have taken place, right? So you prepare the financial statements from the adjusted trial balance. And then, closing entries are there's temporary accounts. Revenue and expenses are temporary accounts that then get flushed through in the cash flow statement through to the owner's equity account on the balance sheet. And so those are closing those temporary accounts, and then they start from zero again, right? The next quarter, or the next month, or the next year, your revenues and expenses are zero, and then you start over again. And after closing the trial balance, you prepare a post-closing trial balance in order to check all the accounts one last time. So this is a thorough accounting cycle and how you'd step through all of these steps to get from entering all of the journal entries, and then creating a general ledger, checking the trial balances, and creating financial statements. So, like I said, the good news is the accounting software perform a lot of these tasks for you, right? You only need to be familiar, you only really need to enter the transaction. So you need to know when a transaction happens, there was a check cut or something to some vendor, or you got a receipt or an invoice, and now you're going to post it into the account. What do you do? And you need to be, you also, you're just entering the transactions, but you need to be familiar with the process so you can quickly troubleshoot any mistakes if the balances between debits and credits don't match. And believe me, that happens a lot. And you'll make a lot of these mistakes, but there's no need to be concerned. That's part of it. Even very experienced accountants make these errors. The key is to realize it and quickly locate them and fix them. The accounting cycle process provides the step-by-step methodology and helps us error-prone humans to do it right. So, the accounting cycle is a methodical set of steps that help ensure the accuracy and conformity of financial statements, and that's really crucial. You follow these steps like a recipe. Computerized accounting systems have helped to greatly reduce entry and mathematical errors in the accounting process, and the uniform and rigorous process of the accounting cycle also helps reduce mistakes and maintain consistency. Accounting is a detail-oriented activity. That's what all about. The devil's in the details, right? And the details are where all the information is too, right? The accounting cycle steps are a checklist that helps promote accuracy. And like I say here, the deity is in the details. So there's the overview of the accounting cycle, and then we'll go through this in more detail, each of these steps, and especially talk more about debits and credits and understanding those, and journal entries and the whole deal. So now that you have an overview, the next set of slide lectures here will be on going into each one of those steps in a little more detail. So I'll catch you then. Thanks.